Welcome for another report on the oil market. The oil market had performed its strongest single-day sell-off in months on Monday the 19th of July, leaving investors stunned with its price action. The oil market's recovery, which has been steady in the current year so far, may need to be re-examined at this point, as a change in fundamentals may have prevailed. In this report, we will be looking into the most important updates in the oil market and how supply and demand are affecting currently. As a closing, we will be providing a technical analysis for WTI, giving important levels and trading scenarios. Monday, multiple media sources confirmed virus cases being on the rise across the world, with the variant being in the epicenter of attention. US cases of COVID-19 were up 70% over the previous week, according to Reuters, while some countries like Australia have even imposed new lockdown measures in various locations. Investors' fears may have been intensified over further economic slowdown, possibly presenting itself as a consequence in the near future. Of course, the main worry connected to the oil market is that fuel demand could be reduced as the virus continues to spread and movement is reduced. WTI and Brent oil lost very notable ground on Monday on traders' concerns, while we must note that it is not clear yet to what extent the impact on oil demand could be felt. Furthermore, and in addition to the concerns over the virus, developments on the OPEC Plus front that took place during the previous weekend may have also swayed investors in making rational decisions and even doubled the effect on oil prices. OPEC majors like Saudi Arabia and Russia agreed to a request from the United Arab Emirates to uplift oil production. Initially, a disagreement had manifested over the matter, but according to Reuters, OPEC Plus agreed new output quotas for several members from May 2022, including the Emirates, Saudi Arabia, Russia, Kuwait, and Iraq. The compromise deal could unlock more crude barrels to a considerably tight oil market. Yet very imposing was the oil market's reaction on Wednesday the 21st of July that rebounded higher and regained most of the ground lost under the circumstances mentioned before in the previous days. Analysts note that oil demand is constant and possibly on the rise despite the uncertainty created by the virus spread. Oil prices also rose despite the weekly oil market indicators displaying figures not warranting for such a move to take place. In the past days, the AP released a surplus of 0.8 million barrels, going against expectations for a considerable drawdown. Adding to that, the EIA indicated a surplus of 2.1 million barrels instead of a drawdown expected. In this case, both indicators should have set oil prices considerably lower, as the number of barrels seems to be in excess, accounting for the previous week ending 16th of July. Yet contradicting the previous reading, Baker Hughes' oil rig count figure rose to 380, adding 2 more active oil rigs compared to the previous week. Finally, as a side note, the Financial Times stated that Saudi Aramco, the world's largest oil producer, was dealing with a cyber extortionist in the past days, as some of its company files had been leaked via contractor. The cyber extortionist claimed to have seized the data last month and demanded a $50 million ransom from the company. Moving now to the technical analysis in WTI's 4-hour chart. WTI has had a remarkable run higher, testing our currently noted as 368.10 support. This level was tested extensively, as noted in our chart, and it was reluctant to be breached, indicating traders may be viewing it with considerable skepticism. When the S3 was tested, the RSI indicator fell at 19.5, which is indicated with a blue line beneath our chart. However, the upward run that basically left behind the S2 67.80 support and higher the S1 69.10 line is equally steep and has pushed the RSI over the 55 level for the time being. With the rebound and sudden change of direction higher, the commodity is now trading just above 70, which may be hinting a move even higher. If this scenario comes into play, then the R1 72.45 level could be tested initially. Higher, we have also noted the R2 74.10 level, which was tested from the 13th to the 14th of July. Our top level for this analysis is the highest level reached since 2018 and is noted at R3 75.75. With the recent upward movement, we tend to keep a sideways bias for the commodities price, with probably some price action being between the R1 72.45 level and the S1 69.10 line. Thank you very much for your time and focus. We appreciate your participation. And if you like this video, please feel free to share and subscribe. Please note, as an effort to support traders as on many fronts as possible, we are now presenting live weekly webinars on trending subjects, and all our subscribers are welcomed to participate. From everyone here at IronFX, best wishes for solid trading.